Home Depot on my radar as well. We'll have Blake Millard on the show today. He sent over some fantastic charts. So very excited to hear from Blake. We'll have Patrick Donawilla on from the chart report. That'll be around 9:40 or so. And that is the rundown for the day. So good morning, chat. Hope you all are having a good start to your Tuesday. I know I am. Let's get the show on the road. Bring on Steve and JC.
All right, Spencer Israel, my question to you is, what is more interesting? Is it the tokenization of financial assets, or is it the memification of the financial system?
Whoa. Aren't those things, couldn't they kind of be considered the same thing in a way?
Nope.
All right, then I'm going to go with the memification of the financial system.
The
Let's talk about it.
memification of the financial system. That's more important to you than the tokenization of assets?
Oh, I thought you asked what was more interesting.
Yeah. Sorry. You're right.
Okay.
What's more interesting? What's more interesting to you?
The memification of the financial system.
Memification is more interesting now. Which is more important?
The tokenization, probably.
Yeah.
The meme stuff is fun, but it's not your vegetables. It's your dessert, right?
Yeah, that's probably true. That's probably true.
Yeah.
Quite the episode that we're watching here on this episode of the financial markets. You know, it's important to look around and observe and kind of watch what's happening. You have prices moving, you have people taking advantage of it and making money. You've got people that are just having fun with it or laughing at it, and there are people who are very upset about it. And I think the people that are very upset about it have like deeper depression issues that things like this sort of expose, and you could see it. They run rampant all over Twitter, so upset that, you know, GameStop's up 100% or whatever, Donald Trump thing doubled and all these things. They get very, very angry. And it's not GameStop's fault or, you know, shorts getting squeezed. You know, it's like a personal thing. And they have other issues. So just keep that in mind. You can observe by looking around, especially in these sorts of environments, so you know to avoid those people and stay away from them because they've got deeper problems, and that's not your concern, right? It's not your job to help them. They're not going to listen to you anyway. So mind your business and leave those people alone. They need help.
I mean, there's always going to be somebody angry at something, but I feel like if you're angry about this happening, it's probably gonna happen again, right? So like get used to it.
It's definitely gonna happen again. Right? We know that.
Yeah. So
that's the one guarantee in this market, and the one promise I'll make you. The market doesn't give us a lot of guarantees. It doesn't give us a lot of certainties. But one thing for certain, one thing that is a fact that will continue to happen is shorts getting squeezed. It's been happening forever. It will happen forever. We're going to keep seeing it. It's just part of the markets. It's the way things work. You're seeing those margin calls today. These margin clerks are spraying the hell out of these markets. And voila, this is what happens.
That's it.
All right, we did it.
Yeah, I mean, that's pretty much where things stand. All right, let's do state of the markets.
All right, so this morning we've got the Dow futures doing absolutely nothing. Dow futures down 60 points this morning. No big deal. S&P futures down 10 handles. That's about 20 basis points. You've got the NASDAQ futures down close to 1/3%. So I don't want to say that the market's not doing anything this morning, slightly down. Bond futures down, back under 116 for 30-year futures, down 1/3%. 10-year futures down as well. Gold 23.50 up a little bit on the day. Silver 28.5 up a little bit on the day. Copper absolutely ripping new 52-week highs this morning above 480, 483 to be exact, up 1.3% on the day for the copper. Crude oil down 50 basis points, hanging in just under 79. You've got the volatility index back pushing towards 14, and over in the funny money, you've got Pepe, by the way, making new all-time highs, really participating with this, with these memes is really what we're seeing here, in my opinion. So something to be said there from a cross asset standpoint. Bitcoin down 1,300 points this morning. So really interesting that you've got Bitcoin down 1,300 points. That's 2% for Bitcoin. Whoops. That's 2% for Bitcoin. Meanwhile, you've got other tokens that are really, really ripping.
Hey guys,
What's up, Strazza? Here, let me just finish
What's
this
up, man?
real quick.
I heard somebody talking about Bitcoin.
Yeah, we're gonna get into it in a minute. Ethereum down almost 2% on the day as well, just under 2,900. Solana is down 70 basis points, just around 147, and then total crypto market cap, Spencer Israel, 2.2 trillion. But let's get into what's going on here. Strazza, yesterday you alluded to, sort of these the short squeezes taking place as something that's bullish, perhaps bullish for Bitcoin, perhaps bullish for the market. I'll continue to push back on that. I'm just not seeing it. And I think today's a great example. You've got Bitcoin and Ethereum down 2% on the day. You've got Pepe up 10% on the day. Last I checked, GameStop was up 100% pre-market. GameStop is now up only 120% pre-market, with after doubling yesterday and tripling over the last few weeks. And then you're just not seeing it in the broader markets. You're not seeing it in Bitcoin, which leads me, and I guess my guess was that yesterday, but as we continue to get more data, the market keeps proving this is an individual thing. No,
let me stop you. What's the point you're trying to make?
by the way, it's a great trade.
One morning, based off one morning, an hour before the market even opened?
No. What I'm saying is people are like, oh, this is evidence of extremes in sentiment. That's not what you're saying, but people are saying that. I don't think it's that. People are saying, you're saying that this is overall bullish for the market. I don't necessarily know that I agree with that either. I don't think it's bearish for the market. I just don't know how bullish it is. To me, these are individual situations. Aren't Strazza right? Like, you and I, we go out of our way to identify these specific opportunities where shorts are really vulnerable for a potential squeeze. We quantify the momentum changes because we all agree that, this is a phenomenon that feeds upon itself. Once momentum gets going, it could really go. But it seems to me, just generally speaking, I don't necessarily know that there are broader market implications by this. My thoughts.
Okay, so short squeezes aren't going to buoy the broader market, right? But short squeezes, ones that are very extreme, go back 4 years on the GameStop chart, they happen in the heart of bull markets. That's when these massive squeezes take place.
Yeah.
Freshly squeezed report. We're going to talk about this afternoon.
By the way, they could also come early in bull markets, not necessarily. They don't have to be in the middle. But to your point, yes, I agree with that. These are bull market things.
You can find me examples where they happen in bear markets, I'm sure, but they're bull market things. Okay.
Yeah, what I'm saying is they can happen early in bull markets. They don't have to be like in the center. Is my point. They can. We saw that.
Regardless, they happen in bull markets.
In bull markets.
Yeah.
There's a reason why we only do the freshly squeezed report when we want to, and we don't do it on a regular schedule because it's not for bear markets.
Yeah, that's right. I'll give you that. I agree wholeheartedly with that.
No.
Yep. So to flip that on its head, these shorts getting squeezed is a characteristic of bull markets, right? Which is perfectly normal. It doesn't mean that there are broader market implications outside of that based on the short squeezes that we're currently seeing.
Yeah, and like we could run that list in the bear market and find one or two that are going to squeeze here and there, but like this is pretty broad for our short squeeze list. No, there's just a lot of action. GameStop is stealing the show here and getting all the headlines about it, but we're squeezing left and right different names on this list every day. That is what I mean. I think lends itself to more of a bull market than a bear market.
What else, observing, what else stands out here? Kind of just seeing what's going on with the Trump coin, seeing what's going on with GameStop, Carvana, just kind of broadly speaking. I'm glad you mentioned, drop the link for 4 o'clock today, guys. If you're wondering how we calculate which high short interest stocks or which stocks in general are ripe for an opportunity to squeeze. We call it the freshly squeezed. We're going to talk about it today. We're going to walk through exactly the math, how we reverse engineer what it takes for these things to occur. And there's a reason why GameStop is right at the top of that list, as well as a few others that are squeezing. But we'll talk about that math. The math is actually pretty simple. It's not that complicated.
These are not safe stocks. In many cases, these are really not quality names at all. There are some quality names on the list, and those are even better opportunities for longer time frames. But for the most part, these are very risky speculative stocks. They're cut from the same cloth as ARC components, right?
Yeah, but Strazza, you said it yourself. There's a reason why so many people are short. These are not right. Like word's gotten out. These are crappy companies, right?
When investors are bidding up these, some of the riskiest assets that we have available to us in the public equity market, it's good stuff. Animal spirits, baby. Bulls. Bulls are out here.
Yeah, you think?
Yeah.
I don't know.
I'm going to convince you.
I would throw these stocks into moving into two groups, right? There are these stocks that are having genuine short squeezes that have a high short interest, high days to cover, the things we'll talk about later on. And then there are the stocks that maybe don't, but are memey nonetheless, and maybe they have a low float and they're small market cap and they're easy to push around.
Isn't Trump that way? Isn't the Trumper that way?
Sure, for sure. Right? Yeah.
There's not like some sky high short interest there. It's not on our list.
No, small. I mean it's not sky high. Actually, I don't think it's high at all. But there are other ones as well. I'm thinking about like BlackBerry, right?
Also Strazza, the Trump situation, there's a certain level of anger that is equivalent to short interest, right? Like we talk about this all the time.
You nailed that. The psychology behind why that trade might work, I don't think you could have been more spot on. And what's too bad is that people are still talking about their last earnings report. It's got nothing to do with that. It's got absolutely nothing to do with that. So maybe this will be a lesson for new investors this cycle.
No, it's great because every time I tweet about it, I get like this whole like fundamental analysis on like how much revenues they do. Like I give a crap, or that the market gives a crap for that matter. If the market cared, I would care. That's the funny part. Like I have no problem caring about that stuff. It's just that the market doesn't care. So
all of these,
who am I to think it's important if the market doesn't?
So that's a characteristic of meme stocks, right? They come with really strong emotions, and because of those really strong emotions, these tickers tend to be extra volatile, right? Price is driven by human behavior and the emotions of market participants. So these wild tickers, it's because of the crazy people behind them trading them.
I just want to give a huge round of applause to the AMC financial department this morning, or I guess yesterday. These guys are, every chance they get, they are selling shares to the open market, and I love it. They just got a $250 million gift in the form of a Keith Gill tweet. So Warren Kitty tweets, meme stocks go up, AMC goes up, AMC CFO says, oh, this is probably a good time for us to do that at the market offering that we talked about a while ago. Let's sell some stock in the open market. Boom, done. $250 million.
These squeezes, they help these companies stay alive.
Sold to you, sir. No. Ma'am.
Somebody mentioned BlackBerry in the chat. We've been looking at it. It's on the list. These are the kind of setups you could take shots at. I mean, Jason,
throw up slide 2.
You see the BlackBerry here hooking?
Oh yeah, I see it.
Yeah, I mean, look, normal market environment, we're not going to get excited about this. We're not going to write about this, but BlackBerry, you could define your risk. I see a pretty clean level here around, I don't know, really the COVID lows. What, like 3.25? Go for it.
Yeah.
I will say, JC, though, it's important we should mention, right? This move from GameStop, you have the tweets from the Catman, but you also have a far higher short interest and also a very aggressively high days to cover ratio, depending on how you calculate it, what kind of volume average you want to use. But GameStop does stand out as a more heavily shorted name than even the other names on this list, right? So that there's mechanics behind that, and that's why you're seeing these massive.
And again, we'll
moves.
go over it this afternoon. Spencer, drop the link. We'll go over it today at 4 o'clock, and we're going to talk about, one of the things we're going to talk about is that margin clerks don't use limit orders. And that's like a really, really important concept to understand. When the margin clerk says you're fucked,
they're just
going to shoot, they're going to spray the market. They're not going to be like, oh, let's be fiduciaries and worry about the LPs of the fund. No. Spray the market. Don't matter how bad the fill is. Doesn't matter. They don't care, right? Because they're the ones at risk now. The broker is the one at risk. The LPs are already blown up, right? The GPs are blown up. They don't care about them.
Yeah.
They're only worried about themselves. So they're going to spray that market and they're going to eliminate that risk altogether, right?
Yeah, I agree. I very much agree. Do we have a Zim chart just to kind of show how these work? And we'll talk about this afternoon. You manage these a little bit differently. You almost trade these as if it's a short. You're looking for a quick move. You want to pay yourself very fast. GameStop, you should be paying yourself if you didn't already. If you're not paying yourself, you're insane.
Right. Take a look at take a look at the Pepe. This is the one that I think is part of this theme where other things like Bitcoin, like the Nasdaq, are not.
This looks like this now.
New all-time highs for Pepe.
Blast off last night.
This is now been blasting off. Now $4.6 billion in market capitalization, 23rd largest token. I mean, this is what would be equivalent to a mid-cap stock.
Well, I can't buy it on the Coinbase. It seems to me.
You don't need to buy it in the Coinbase. You buy it on Radium like a normal person. It's not a big deal.
Well, some of us have rules.
Well, you have stupid rules. You don't buy a token because you don't like Radium because you have a hard time spelling it.
Hey, the chat's enjoying this discussion. Let's keep it going. JC, a question from the chat for you. Based on this action, I know you disagree a little bit that maybe it's not as bullish as I think. It says if you're short, you have to cover.
If you're short, what?
Exactly. I don't think that's the case. If you're short,
what?
If you're short, he's just
meme
saying
stocks.
You're short, you got to cover. I think
meme stocks. If you're short meme stocks, you should see a therapist.
Yes. First of all, you should almost never be short meme stocks. Really, as a general rule, it's just silly. The risk reward is no good for you. If it can,
Strazza has stupid rules for sure, but this is a good one actually.
Don't short meme stocks. If you want to go long meme stocks, have some fun, go crazy for a little bit. All right, fine, take your shots. I was thinking yesterday, you don't score if you don't shoot, right? You got to shoot. You got to shoot your shot on these GameStops. And I think this is a good environment to take your shot on these. I don't think you have to go cover broader market shorts, at least not right now. When correlations start spiking, like JC mentioned, which will come towards the later innings of this cycle, then maybe you don't want to be short the broader market or many things. But we're not quite there yet. I think we're heading there still. But broader market short, I think, is okay in the context of what's happening. I don't like it, but I think it's okay. Right?
Yeah, I don't like broader market shorts.
I don't like it, but I don't
says,
think GameStop has anything to do with it. Is kind of my point.
And I don't think it's a sentiment thing. People are like, "Oh, this is extremes in sentiment, all this stuff." I don't think that's true at all.
It's a risk.
Quite the opposite. We quantify sentiment as good as anybody else, and we're not seeing any extremes in sentiment at all. I don't think this is a characteristic. I don't think this is a sentiment thing at all. I think this is shorts getting squeezed, shorts overstaying their welcome, irresponsible market behavior. Yes.
It speaks to risk appetite, though, right? Investors want risk, right? They're favoring some of the riskiest stocks in the market.
I'll give you that one.
So that's never a bad thing. This Zim shipping, I'll be looking to get out of today. A couple days, great. We got some sweet follow through. I'm not going to overstay my welcome in these names.
These shipping stocks. Yeah. Seriously.
Yeah. Listen, we're going to talk about so many great setups tonight. I'm really excited about this. Let's leave the rest.
So again, just to reiterate on that, the link to today's live event, it was on the screen. I'll bring it back up now. It's QR code, but also it's at the very top of the chat on YouTube, and it's at the very top of the description on YouTube. Use that link today, 4 o'clock Eastern. These two guys are going to talk about how they find short squeeze ideas and then how they approach them after the fact. Because we talk about trading them or not trading them or shorting them or not shorting them, and they're going to go into a lot more detail today at 4 o'clock. So there is the QR code. Links in chat, links in description. Be there or don't be there and miss out. I mean, it's up to you. I don't know what to tell you. So, okay, 8:52. Before we bring on Blake, you guys want to talk some Alibaba?
Please,
or
what's going
some
on?
or some Home Depot?
A gamma ramp.
Your what?
Nothing. Just saying fancy words here. Let's get Blake.
Okay,
on.
well, let's start with Home Depot here.
Oh, we're doing.
Well, and do some earnings. So, Home Depot, we're down like 1%. Yeah, down about 1% pre-market. Low expectations for the company. They did come in. It was mixed. They missed on the top line, beat on the bottom line. Comp sales down about 3% year over year. That's total and just in the US. They reaffirmed their guidance for the fiscal year. But like I said, a low bar for them, obviously, with the real estate market at a bit of a standstill right now. Expectations are low for Home Depot, and that's mostly what they talked about. So,
You see this chart, Spencer? You see what was done here?
which time?
This chart's very important.
Okay.
Notice how we zoomed out.
Yes.
Not like most people would zoom out, but we zoomed out 3 decades. 30 years of price history. That's the context with which you want to analyze a stock like Home Depot within, right? What am I talking about? Secular leader. Zoom way out. You're not thinking about trading this one. You're not thinking about how much money you're going to make today or tomorrow or next week or next quarter even, right? How much money are you going to make in Home Depot if you hold it for the next couple of years? Or you hold it throughout the remainder of this cycle, however long that goes. That's the way you want to think about a stock like this, right? You could buy dips, you could buy weakness. We could zoom in on this chart. Actually, I'm getting one ready. You have a pretty clean level at a shelf of old highs. With something like this, you find a level to enter it responsibly where you can manage your risk, and you want to have a longer time frame. This is a sweet uptrend. This stock broke out, I don't know, 15 years ago.
Yeah.
Never really looked back.
Well, what I see is just that 2020 or 21 highs, right? And then just consolidation since then. But
let's look at it another way too. I like this.
Okay.
Is Lowe's doing poorly still, or Lowe's is doing all right now?
No, I thought it was doing all right. I mean,
Like the stock?
Doing all right.
Yeah.
Right? It's okay.
I mean, it peaked with a lot of things in March.
Not
It's flat for the year,
yeah.
like so many things. But I mean, that's part of the course, right?
Not knocking the doors off, but it's doing okay.
I mean, it's trading with the market sideways.
Yeah.
Right. Slightly outperforming a little bit, but kind of, not the worst in the home building and home construction space. Certainly not the best. No?
By the way, well, yeah, sure. By the way, my Home Depot spending all-time highs. All-time highs.
Well, you just moved. So
yes, that's exactly right.
The recency bias is off the charts.
You're right. Very true.
It doesn't get any better.
Thanks.
It doesn't get better. You're in the house now. You're going to keep spending.
I know. All right. Wait, what is this other Home Depot chart? What is this?
I just dropped
shorter term. This is the retest.
Data's a little funky, but it's important to highlight this little shorter term level. Sorry for the ugly chart.
Pretty ugly.
340. I don't know. I'm having weird data stuff going on. I was having a problem with my camera this morning.
It's the memification of financial markets, Strazza. It's getting to you.
No, it's funny because everybody was complaining yesterday about things not working because of GameStop. I don't know how true that is, but like my Coinbase was down last night. I usually, when I wake up in the middle of the night and can't sleep, I buy crypto. I don't know what you do. Like some people read books or like watch old episodes of Friends. I just buy crypto. Last night I was just laying in bed. I couldn't do that.
Damn.
And
I
everybody's
couldn't sleep last night. That's what I should have done.
It's definitely super junky. AMC up 130% right now. GameStop also up 130%, just for the record. BlackBerry up only 25%.
Can I run through? Wait, let me run through a little bit because I mean it's more than that, right? BlackBerry, you mentioned. Beyond Meat up 18%. Tilray up 10%. Going through here, Beyond, like BYON, like Beyond, like Bed Bath, the old Bed Bath and Beyond, had itself a nice day yesterday. Is up this morning. Remember KOS? Remember KOSS? Steve does.
Up 40%.
Yes, I don't remember that. No, I don't know that.
I don't remember
that either.
I don't even know what they do, but they were there. They were there a few years back.
Consumer electronics.
Okay, if you say so.
From Milwaukee. Up 40% this morning.
Yeah.
You know. Yeah.
Yeah, but this is a penny stock.
Listen, it was there a few years ago. That's all I'm saying. It was there.
They're doing like yeah, whatever. They were promoting like penny stocks on CNBC yesterday. I've never seen that before in my life. I don't know if anybody else saw that in the chat, but I was kind of blown away.
I wouldn't know where to watch that channel.
Oh yeah, well.
Like, you watch it on the internet?
No, I watch it on the TV.
That's weird.
Same as like Knicks games, just on the regular TV.
It's odd.
Yeah.
Okay, boomer.
What else do we have?
Bring in Blake to talk about actual things that matter.
Wait, come on, finish any big earnings reports.
Yeah. Wait. Can we do Baba first, and then we'll bring Blake on?
Yeah.
So what's Baba down now this morning? About 4 or 5%, somewhere in that ballpark. Also, not an amazing report. They did all while they were at it. They beat on the bottom line, miss on the top line. They also declared a 2-part dividend. There's an annual dividend and a one-time cash dividend.
Can we hit the cheers thing, the applause? Because I'm a big fan of these Chinese companies coming out and returning cash to shareholders. I'll tell you why. Somebody joked in the chat or on the show yesterday, oh, Alibaba earnings, does it even really matter? Guess what? You might not be able to believe a lot of the numbers that these guys report, but they're going to pay you cash on a quarterly basis. That's real money. That's real money. They're doing something right. So I think while, yes, we can't believe a lot of things that come out from these companies, the ability of some of these companies to pay dividends, I think, is pretty cool. So we saw it with 10 Cent Music the other day. That's why I'm bringing it up. Good for Baba.
Yeah, that's a good point. That's 2 in 2 days. Very good point, Steve.
I think that's very good policy for the people who run these companies. Right?
Yeah, I don't disagree. So anyway, like I said, down 5%, kind of the same lukewarm story as Home Depot, just from a expectations perspective. And that's pretty much all they got for earnings. There's a couple more, but nothing too interesting. Tonight
in the Baba, it's at 78 level, I think.
All right.
Blake
is here. Should I bring him on?
Yeah, Blake.
All right.
Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Blake, what's up, my man?
Hey, good morning.
Sound good. Look sharp. Look like you're ready to go play golf.
I was supposed to, but I don't know what your weather has been like up where you are, but sorry, my mic just fell. We've just had horrible weather. Our spring has just been nothing but clouds, rain. Still waiting for those blue sunny skies of the spring, but yeah, I think the last time you and I, JC, the last time you and I spoke,
or is that a low bar?
What'd you say?
How's your golf game? Is it better than Strazza, or is that too low of a bar?
I think when we played, we shot about even, if I remember. We played down in the Keys back over Christmas break. I think the last time you and I spoke, in fact, I was actually on the golf course.
Nice. That's right. We did. I'm glad you're here because you bring a unique perspective, different than ours, to the markets. And here we are talking about GameStop up 130% today after doubling yesterday, and AMC and BlackBerry and all these crappy little stocks that are blowing up short sellers left and right, and it really does bring a smile to my face. A few things in this world make me as happy as a good short squeeze, right? How do you, first of all, explain to the audience from what perspective you come to the market, what your day job looks like, and can you put what's happening currently into context? Do you think about it at all?
So I am the director of investments for an RIA. So our money is much more long term. We manage a lot of retirement money, IRAs. John Miller from Oklahoma, we're looking out for like his longer term retirement accounts and growth. We're not necessarily doing a ton of day trading, so we're probably a little bit different than your core audience here. But when I see stuff like this, it is sort of just noise to me. I heard you and Straz going back and forth on this yesterday and today. Great perspectives. Just when investors seem to be regaining like their rationality, their sensibilities, a roaring kitty causes this nonsense in capital markets. It's actually pretty wild that someone can send out not even a message. It's literally a picture of a guy leaning forward,
did Roaring Kitty really
ready
set
to
this
go
off?
with his controller, and it causes retail to just go crazy. This is the man who obviously famously kicked off the last meme rally. I actually was just kind of curious. Again, I'm more a little bit fundamental in my nature. Love incorporating the technicals into our process, but I was just curious. Just what did the last earnings report look like from GameStop? Just curious. Just humor me for a second. Same story. No different than it was 3 years ago. Same sales. I can't remember if it was like year over year or quarter to quarter, but sales were down 20%. Standard consumer spending issues, ongoing shift to game sales for online platforms, several rounds of layoffs. But we know that meme stocks don't trade on fundamentals, right? You guys were saying that this is a much more
I would argue
emotional
that
thing.
stocks in general don't, which is why I ignore all that stuff, meme stock
well,
or otherwise. Right?
The one thing I would say, though, that is maybe a little different this time, there's like two things I think that come to mind. I was reading a Bloomberg article this morning. I think the percentage of shares sold short is something like 25-30%. And I think it was more like 150%, which, remember, that was like breaking people's brain. How is there more outstanding shares short than there is just in the actual stock of the company?
What's unfortunate is that the geniuses over at the regulator's office only publish the short interest data every 2 weeks. This is something that the blockchain fixes because you could see it in real time. So I think that we're heading towards a more real-time short interest schedule. So that'll be more helpful.
It's still nothing like it was a few years ago, though.
Yeah. Well, so another point that I was going to make was I think just the world is very different now. We're not in the pandemic, so you don't have these legions of degenerates just sitting at their home on their couch with nothing else to do, betrayed. So I think there's just like a slight cultural shift as well. So like you have less shares sold short outstanding. And I guess you don't have, I was almost going to watch the movie last night just to kind of like refresh my brain. I forgot what the name of the movie was called, but they also do
not
have
financial advice or something.
Theory of Melvin Capital, where it's like we're taking on the hedge funds, and it's like the small, David and Goliath kind of thing. So I think there's just some differences, subtle differences, but can the squeeze go higher? Absolutely, why not? Of course it can. But the orders of magnitude of silliness and these returns. Straz, what did you say? It climbed. What was the percentage?
I got it right here. So based on the most recently reported data, 24%, and we got them at a days to cover ratio of 10.
Yeah, and then Blake, the whole thing with this is that whether it's 20% short interest, 30%, 35%, whether the days to cover is 12 or 13 or 19, like it doesn't really matter to us. And we're going to talk about it later today, where we're going to really dive into the short squeeze setups. But it really is just a matter of is there a potential short squeeze or not? Like 3 more days to cover or 3% or 4% more short interest is not going to make or break any of the decisions we make. We just want to say, okay, does it fit the bill? Is it high short interest? Yes. Is there a ton of days to cover? Yes. Okay, let's go in, right?
Yeah.
It's more like that than the specifics of, because at the end of the day, we know that we don't know. We know that this is incomplete information. We know that it is guaranteed that it is incorrect information because we already know that it's old data. We know that, and that's okay.
And,
that's okay.
And at the end of the day, here's what really matters. The price action, at least over the past few weeks, and particularly over the past 2 days, is exactly like it was back in 2020 and 2021. And that's what's going to pay you at the end of the day. So maybe the short interest is a little different, and the legions of crazy people is a little bit different, and we have no pandemic. Oh boy. But GameStop was up 100% yesterday, another 100% pre-market.
Yeah, but look around, and we'll finish on this because I want to hear what Blake has to say about actual assets that matter. The difference is, in this case, is that we were at the end of a parabolic move. We were at the end in the last go around in 21. This was the end of the greatest 52-week return in the history of the United States stock market. Let's remember that. So the parabolic nature that went into this, the last go around, is not what we're seeing now. Like, we haven't seen that parabolic nature. In fact, quite the opposite. It's been a pretty boring last 3-4 months for most stocks. We haven't seen what we saw last time. So it's not that this time is different, it's that every time is different. This is just different in that particular way where it hasn't been a parabolic last 52 weeks. Not at all.
No, it's a great point. And as you asked earlier, how does this kind of play into our process? I mean, this doesn't. This is just fodder for, the headlines. It's fun. It's kind of, it creates things for us to chat about. It creates a level of excitement. As we know, last time it brought in all sorts of investors. Robinhood was opening accounts left and right. They couldn't even open them up fast enough. We know that. So it's kind of just, a resuscitation of this strange market dynamic that, comes and goes throughout different periods of time in history. So how that affects my day-to-day and how we're managing client capital and communicating with people, it's pretty much a non-issue. I mean, we're looking much more, as you said, at broader trends in the market. We just got through earnings season. I brought some stuff on that. There's a lot more for us to chew on, I think.
All right, so let's chew on things that matter, Blake. Bond market continues to fall apart. Last year's leaders have turned into the laggards. You look at the worst performers over the last 10 weeks, it's technology, it's consumer discretionary. You look at the best performers, you're looking at gold, silver, copper's hitting new 52-week highs today, utilities, energy, consumer staples. This is, to my earlier point, this is just not the type of market that we were in last time it was this aggressive of a meme season, right?
Yeah. No, it's been a very, very different market. Just broadly speaking, we remain generally positive on the market, particularly given that the recent move higher has been pretty broad-based and coming from different areas, as you just noted. It's been a quiet, resilient bull market because it's so diverse and because this is all in the context of all these rate cuts that was the whole narrative coming into this year. How many cuts are we getting? In mid-January, I believe we got up to almost 7 full cuts getting priced in.
Yep.
And now we're down to like 1, maybe 2. It changes daily, but I would just think that markets have been incredibly resilient, given that was so much of the narrative that, equities are going to only be pushing higher because of these interest rates that are coming, the cuts. And we know that they've been wiped off the table, and perhaps not everything is continuing to climb higher, but we are churning. New things have stepped up. So this is not a bull market, as you just noted, that's being led by tech or semis right now, by momentum, NVIDIA. This is, they're all doing fine, of course, but leadership has just come from different areas. And we know that sector rotation is perfectly normal. In fact, quite healthy. I look to last week's leaders. I think utilities, obviously, that's where a lot of the strength is recently. We had financials, materials. These are things that, these are different groups for the average investor. So, we're getting a good market across the board. I think I'd add a little caution for now, especially for like new money that might experience some short-term indigestion for, people that are thinking more long-term. You have the major US averages, the SPX, the Dow, the Qs. They're all pushing back towards new all-time highs. They're sitting right below overhead supply. Do we break right through? Probably not. That's not usually the highest probability move. It might take a couple of goes at it, but probability weighted. The next move is likely higher than lower. The S&P is up. Where are we at now? We're at 9.5%, which is about the average return over the long course of history. We also know that markets rarely ever produce an average return. So if we are at the average return and we still have 7 months to go in the year, if for whatever reason we always have to talk about calendar year performance, which is so arbitrary, but that's how our brains function. Like I said, I just think there's more likelihood of an upside move than a downside move. I brought a bunch of charts if we can get into them, and that'll kind of explain our thesis. But I mean, it comes from a variety of different things. Underlying trends are generally bullish, even if they had some mess over the last couple of weeks and months. Volatility is low and falling, whether you're looking at the VIX or, the VIX of the VIX. Credit spreads, tail hedging demand, that kind of stuff is low. We learned all year now that the market doesn't need Apple, which is fantastic. That just, again, goes to show that there's other areas that can produce leadership.
By the way, neither does Berkshire Hathaway. When you look at the performance of Berkshire, despite its weighting in Apple, is very impressive.
Doesn't it tell you something about internals? There's so much other stuff working.
No.
Yeah, I think it might.
No, it tells you, well, yes, but more specifically than that, insurance, reinsurance, industrials. Think about what Berkshire owns. So yes, internals, but those specific internals, right?
Yeah. Like, we got you. If you want to share yours, I think you can do that too.
Yeah, I was just going to say it might just be easier. I was just going to share my screen if that works.
We got them all in here. Spencer, you want to hook them up with a screen share?
Let me know if you
can. Yeah, he's got it right now. There we go.
Can you guys see my screen?
Yep.
Yeah, I want to hear about your sell in May and go away.
Well, yeah. So, I mean, I just think sort of starting with like a little bit more context to sort of what I was just speaking towards, like why did we start this month in fear? And, we've been getting some questions recently from our clients, just, what's been going on. We had ourselves a little bit of a pullback. So I just wanted to just go through just sort of a few developments quickly, just to see, show people what we're looking at, what's been going on through the first part of the year and how that sort of sets us up for, summer and the rest of the year.
Yeah.
So I have a bunch of these points. In fact, I'll just go through them one by one because I brought charts, but,
yeah,
inflation, yields. So, if we talk about inflation, we know that the disinflation path is essentially stalled out. The last mile is proving more difficult than many expected. The Fed has acknowledged as much. I think hawks and bears have been taking that more as like inflation is reaccelerating, but that's not really my view. We know that there's stale rent data. Used cars are still contributing some wonky numbers. Auto insurance. These are like statistical aberrations, but it's causing, as you can see, inflation to sort of stall out here.
Do you want to explain what this trading down stuff is that we're hearing in a lot of earnings reports, to be fair, this quarter? Question in the chat about consumers trading down.
That is a great question. And I actually have stuff on that in literally like 2 slides. So let me just get to that. I'll get to that question in a second.
Got it.
But, with inflation stalling out, here's a great chart you guys just put on. I think this was from your Chartoons report over the weekend. But we know that interest rates have moved up because of that disinflation narrative sort of stalling out. The 10-year started the year at 3.9. It climbed all the way to 4.7 in late April. Again, as the market is pricing out those cuts, we know that equities don't like that. And after, gaining close to 30% after just a monster 5-month rally, I'm not a technician. I'll leave that stuff to you guys, but name a thrust, a momentum surge.
Yep.
You guys have all these crazy numbers that you guys pull together and have different people that you cite.
The thrusts
All
are
of those seem to be registering. It didn't matter which one you were looking at, with whatever's in your tool shed. They were all firing. So we know that we had a very strong rally for 5 months, and of course we get a 5% pullback. People are pulling their hair out.
with the
And,
dollar and rates so much higher. Should have been putting more pressure on risk assets, and you only
I
got
agree.
at the index level.
Yep.
That's out in your bullet points too.
But yeah, and just one of the points that I was going to show here with there's a great chart from Ryan Dietrich. These 5%, what he's calling a mild correction here, these happen all the time. These are 3-4 times a year. So this is just standard for the course. Of course, can it turn into a 10%? Maybe not. But this is getting to the chat question here. We just mainly got all the way through earnings season. I think we're about 92% having all S&P companies reported. One common message I was kind of hearing and reading about a lot over the last few weeks is companies are facing a profit squeeze. Wages have been creeping up slowly and steadily over the last few years. We know that. Wage gains are finally outpacing inflation, which is good. But companies that were aggressive with price increases are seeing two major notable things. They're seeing traffic shortfalls, so less people coming into their store or their online websites, and we're seeing trade down. So you're looking at a couple charts here on the screen. On the left, you're looking at all your major fast food and QSRs and just the amount of inflation that has been pumped through just that specific sector and those specific companies.
It's been egregious.
Again, those target the general people who are eating at these places. Now, of course, you're getting a wide range, but the general person that's going through the door, those are major increases to fight off because those wages are at the much lower end. So they're having to trade down. They're, instead of getting the 6-piece nugget, there were all sorts of reports that people are just getting the 4-piece nugget kind of thing with their kids.
What you're saying,
Starbucks.
their demographic, it's the kind of people that are hurt by inflation.
Yes.
Yeah, that's fair.
Another thing that was kind of getting me a tiny bit concerned, when you start seeing central banks intervening with their currency, I think that generally might scare people. We don't have to get into like how currencies work and interest rate differentials and all that kind of stuff. The general point is when you have a central bank stepping in what looked like twice to defend its currency, adjusting its policy, balancing growth and inflation risk and all that, it just gets people a little rattled. So I think that was kind of a little bit maybe what we had seen over the last 4, 6, 8 weeks. And then, of course, seasonal weakness. We know about the old, market maxim, sell in May and go away. This is a seasonal pattern based on historical underperformance during this exact 6-month period from May to October. You can see right here at the bottom of the chart for everyone who's watching this live on YouTube that the 6-month return period from May through October is the weakest of all the monthly returns. It's positive, but it's not nearly as positive as some of these others. So this is, again, just sort of this backdrop, that we know from, this is made famous from Stock Traders Almanac, that this is potentially a weaker part of the calendar. And that sort of had been playing out up until this moment. And now we've started to inflect higher. Here's some monthly returns. Basically, the point is here, if you're looking at these charts, May, June, August, September, you're looking at a lot of returns over, since 1950, the past 10 years, 20 years. This is just sort of a weaker area of the market. That's obviously, again, why it gets its name. So sort of now, where does that sort of push us to what we see from here, right now and kind of going forward with that as sort of our backdrop? I would argue that monetary policy, especially with the most recent meeting that we just came out of a few weeks ago, the Fed is essentially graduating from, I think, a headwind to a actual tailwind now. We knew
Yeah.
CPI data had been stalling out for the last 3 months, but Jerome Powell firmly essentially dismissed the idea of hikes,
I love that
which is an important. Go ahead, Steve.
I love that he said this about the stag and inflation.
There's no the stag, there's no the inflation. He also talked about how there's multiple paths to cuts. It's not just potentially inflation sustainably moving down to their 2% target.
He played a
He
little.
also acknowledged that there could be some unexpected softening in the labor market. We know from the SOM rule, that's the rate of change short term versus a longer term measure of unemployment, the tick higher.
Yeah.
It's not at the national level, but it is spiking across 25 states now. So it is happening in certain regions of the country. It's just not at the national level yet. But most importantly, slowing QT, the balance sheet runoff, that was the big announcement for me last month. That is essentially a dovish, pivot, if to use that silly word, but that is them switching policy instead of, slamming on the brakes as they have for the last couple of years. When you're drawing down those runoffs, they're concerned about, again, wanting rates not to run up too high, not having a liquidity issue, but just all of these things together, incrementally dovish, I would think, from the market perspective. I think another thing that's sort of notably changed is the economy is no longer red hot. The softer April jobs report kind of added that came firmly below street estimates. It was like the smallest gain in 6 months. JOLTS report, that's like the number of job openings and layoffs and turnover. That also missed, expectations badly to the downside. As you can see from this purple line, that is on a 2-year descent lower. That's slack coming into the labor market. That's relieving pressure. These are really good things. Go ahead.
When you think about the economic backdrop, we have labor and we have economic growth. You're talking a lot about jobs. What's more important, jobs or growth?
It's a really tough question, and I think you could answer that a million different ways, and it depend on who you ask. I think right now the focus is really on earnings, but I think you got to caveat that with, you can also, it's like a 1A, 1B for me, because the jobs, the fact that unemployment is still at 4 or 5 decade lows. The unemployment rate has stayed below 4% for like 3 straight years. That's
incredible.
This is just incredible with the amount of uncertainty at the macro level, all the layoffs we keep hearing in tech, the changing nature of how employers are working with their employees. We know that GDP is essentially 65-70% consumer spending. Consumer spending comes from people having jobs. It comes from people receiving a paycheck once or twice a month. It comes from those paychecks constantly flowing through the economy through consumer spending. So I would probably maybe just on the spot say that maybe jobs was the big thing over the last couple of years.
Mm-hmm.
But now, as you guys can see on the screen, I think it's changing now. I think markets are nervous about inflation, perhaps maybe a tiny bit of slowing down in the labor market. That when is this first rate cut coming? I think it's caused investors to focus more on corporate earnings than usual. And we've, as I noted earlier, we've heard from 92% of companies. We have 81% beating their earnings, which is higher than the 10-year average of 73. The growth rate right now of how much earnings are growing is just shy of 6. That's the highest in almost 2 years. It's the third straight quarter of earnings growth. The 20-year average is 9. So we're not quite at that robust level, but you can see on this chart on the right, we are hooking higher. And as you see, just looking back through the last 30 years of history that we're looking at, more often than not, when you are reaching the lows of the earnings cycle, which we had an earnings recession, those tend to persist. And we know that Wall Street is expecting to 10% earnings growth this year. I think like 13 or 14% next year. Those are high bars. Don't get me wrong. So it's not, all roses, but earnings are just an important part of the market. We know that over time, longer time frames, not necessarily right in the moment, but stocks follow earnings. And when you see earnings ticking higher, that's important. Here's a nice chart that Austin Harrison put together. The composite index from the New York Stock Exchange. We had that pullback in April, and we had an absolute perfect bounce. Fundstrat put out some great data after you have this monster surge in first quarter, but you pull back in April. What do markets do for the rest of the year? Markets are higher 71% of the time going into the year. End of the year, that's really encouraging. We know that investors had delevered pretty significantly back in March and April.
Aren't markets always up like 70% of the time?
I know.
Yeah, that's a very fair point. But again, just because I guess that speaks to the point is the fact that we did pull back. That can be perfectly normal when you have months and months of surging stocks, more or less. You can only get so overbought or so much buying power that eventually it just exhausts itself, right? So you're going to have consolidation, and you can do that through time or price. And we did that through price, not probably as much as maybe some people were looking for. Time, I mean, we haven't really, you were starting our conversation off with this, that the market really hasn't done much in months. The S&P, the NASDAQ, they're all just back at their same levels that they were several months ago. So, I think I've gotten through the majority of the charts. How we're positioning, ideas that we liked. I know we're coming probably towards the end of our time. AI is still a big part of our sort of 12-month thinking. Tech, that's just a standard staple that we're going to find in our client type portfolios for longer term growth. These Ozempic names, it's just wild. The addressable market for this drug is just insane. And we know that Americans are fat and they can't stop eating and feeding themselves. So at least here in America, these things will continue to be home runs. Financials, industrials, that sort of speaks to, specific with financials, it's rates coming down. With the industrials, it's manufacturing picking back up, and some of these fiscal policies that have been put in place over the years. Bitcoin got to hold 1-2% in long-term portfolios, if not more. I'm definitely not trading them with Strazza in the middle of the night. I'm trying to get my sleep. Mid caps we like right now. I think we'll be trading down to small caps. We're just waiting for more of that confirmed. We're waiting for rates to really just stop going higher. Volatility has just collapsed. Just wild. There's just no demand for this. And you're seeing it with credit spreads. Credit spreads are confirming. So
hold on. So not only is volatility super low, the volatility of the volatility is at historic lows. So what that means to me in English, right, as an investor, is that right now insurance is as cheap as it's ever going to get, and yet no one wants it. What does that mean to you, Blake? And I'd love to hear your thoughts on that too, Strazza.
Well, you can look at it two different ways, right? It's essentially a sign potentially of complacency, right?
You think?
Or it just shows that these are quiet, steady markets. The market's not waiting for the next shoe to drop.
And
it's
you can
not
be
as if
falls.
It's not as if the VIX has to get to 12 and then immediately spike to 20 its long-term average.
Yep.
Or even go one standard deviation up to 28. It can stay this way, and it has. You just have to look at the data historically. I know you guys have. It can stay at this level. So it definitely puts a little bit of caution in the back of my brain. But no, this can sustain itself. Steve, what do you think?
I'll say this, and I'd love to hear your thoughts, Straz. I'll say this. If this sort of behavior or lack of behavior by the volatility index and the volatility of the volatility index came accompanied by extremes in sentiment, extremes in positioning, that would be one thing. But to your point, Blake, low volatility could stay low for quite some time, and sentiment is nowhere near the extremes that we have seen, bullish extremes, quite the opposite. if anything, I would argue sentiment is getting close to a tailwind,
Yes.
more so than anything else. So, you know, I think you want to put it into context. Great point, Blake. Strazza?
You can go long calls all day in this market.
So that's another. So it's a great way to think about it. So if you're bullish on a stock with volatility as low as it is, there's a higher likelihood that the volatility on that individual stock is. It's not always the case, but there's a higher chance. You want to check. There's a higher chance that premiums are going to be pretty cheap, and you can go out and buy calls, you know, far into the future on a stock that you like. It's a great way to think about it.
And unfortunately, I was looking to sell puts against a lot of these former highs, and they're just not paying you. But, you know, that's why I guess we pay attention to these things. Blake, can we talk about earnings? Because somebody in the chat was surprised that we're just coming off an earnings recession. I think the narrative has been too much about this AI's productivity boom, right? It's good earnings from these AI companies. This is just starting. S&P 500 coming off an earnings recession with what seems to be us entering a new secular productivity revolution, right? We can have earnings growth, blowout earnings growth. If you go back to that chart, show what earnings growth did in those last couple cycles when we finally bottomed out and started ramping higher. It doesn't just grow a little bit. You get some massive earnings growth for, you know, a couple years there, can be even longer. And that should or could drive the gains further in this bull cycle. If some people need fundamentals behind the price action to drive it, to make sense of it, it's your earnings growth. That's going to be it.
Yeah, you're right. We know that all this chat GPT stuff, the generative AI, I mean, they've been working on these tools for 10 years, but you know, you had that big moment, whenever that was, late 22 November, I think, when they dropped it. I think that was the chat GPT drop.
November 22.
But it's just getting started. That's why you don't just add hundreds of billions of dollars of market cap on top of these companies unless this is something real. Now, you know, we could have egg on our face in 5 years, and it's silly, you know, nonsense and buzzwords that when you look at it in hindsight, you just don't know. But the amount of money that's being deployed by the biggest tech companies, the runway that has to develop from, you know, we're going to buy this company, we're going to buy this technology. Now we got to incorporate it into our systems. We got to train our people how to use it. Then we got to fire those people who are training, get those systems in place. It starts filtering into new products, new services. Then it starts hitting the bottom line. That doesn't just happen. You know, ChatGPT doesn't just come out in the fourth quarter of 22, and then all of a sudden the first quarter of 23, those earnings are popping. No, there's a ramping effect.
Yep.
And that's just like the first layer. Then it's got to go to the second layers. Then it's got to go to the third. So this is going to be a big part of that tailwind that you were talking about, Steve. And this has a habit of running. If it's truly a new cycle, which to the person in the chat, yes, we had a earnings recession. We had 3 consecutive quarters of negative earnings growth. That is not just them going, you know, up 2 to up 1. That is actually earnings falling from the year below. So we had a true earnings recession. We are now coming out of that, and earnings are expected to run higher. A lot of that is coming from big tech. We know that. It's not perfect.
But it's not.
Broadly speaking, people are really excited on earnings, and AI is definitely a part of that.
As that adoption ramps up, this should impact every company under the sun. Talk to your friends. Ask them what they're doing at work. Ask them if they're incorporating AI in their jobs. Any friends, any job, right? It's happening everywhere. These companies are finally realizing, okay, we got to hire some consultants, get some people in here, have them tell us how we can improve our efficiency using these different AI tools. And then they're recognizing these benefits, and their margins are growing because of it. So I think this impacts everybody. I think it'll be a slow rollout, like you're talking about. The adoption process will take some time. But I think absolutely we're just getting started. And I love that earnings chart.
Can I get one more question for Blake? Blake, what's the Dom Perignon behind you?
JC, so you're not kicking me off yet, but go ahead.
Hold on, what's going on with this Dom P you got behind you? You drinking a lot of Dom Perignon these days?
No, this is my old boss who I just can't stand, but he did get me this really nice thing. It says, Blake, wait, why is my camera so bad? Blake and Jen, congratulations on your engagement.
Oh,
What is
oh,
that? A 2004 vintage?
2004. We
Is
got
there still juice
engaged
in
in
there?
15. So that's something we might never open, but we might, I don't know. We probably won't ever open it.
Why wouldn't you open it? You got a 20-year-old Dom P. Oh, what's the matter?
Nope.
Come on. First of all, you got to lay it down. Can't have
But-
it standing up. You got to
I
lay
mean,
it
it hasn't
down.
been refrigerated, obviously. It's sat here for years, but no.
go
You're
back.
killing me, Blake.
It was a gift for
You're
our
killing me.
engagement. The question I had for you, I can't find my window to share anymore. There was a chart I was going to ask you about because I know you've been talking about breadth so much this year. It's your own chart. I think Grant had put it out. It's essentially just showing the S&P on the top bar over the last 2 years, and on the bottom bar, it's just showing the NYSE advanced decline line.
New
Yeah.
highs.
Advanced decline line is at all-time highs.
Yes.
All of them.
So
Not just in New York. I think
I know you've been
even
hammering
small cap.
away for
Everything's-
months and weeks on breadth. How do you explain that, JC?
Well, breadth. There are a
Because
lot of ways to
generally
measure
they
breadth.
will track together. They might they might diverge over short time periods, but generally speaking, if you're getting an all-time high on advanced decline lines, especially the NYSE, which is I know you guys have argued about this over months, which what measure do you use to define the market, so to speak? But let's just call the NYSE a good broader measure, right? How do you explain all-time highs and all of these issues with breadth and that kind of thing?
Yeah, I mean, I think it really comes to sector rotation is a big factor in it. You also want to think about what universe you're using, and how quality is that universe versus how crappy. So like the Nasdaq advanced decline line has been going down for 40 years basically. The Nasdaq advanced decline line peaked the day it launched, right? So, you want to think about what is it that you're counting first of all.
Sure.
And also advanced decline lines, again, I think are being driven by sector rotation, right? So you're seeing like the returns over the last 3 months, while technology is losing investors money, investors couldn't have been in a worse place than technology, for example, or consumer discretionary. Utilities have been great. Materials have been great. Industrials and financials remain, they're not making new 52-week highs, but they're right there, right? So I think the advanced decline line is more of a function of sector rotation. When you're looking at the list of new highs, right, that is less about sector rotation and more about broad participation,
Sure.
right? So I think all of these different measures give you different information. Is an advanced decline line on an index a bad thing? Definitely not. How good is it? I don't know, right? I think it's more of, how important is sector rotation to you? Do you believe that sector rotation is the lifeblood of a bull market? I certainly do.
Yeah.
So that's why I think new highs in advanced decline line is not bearish at all.
Really
Right.
quick, rapid fire before we leave. Both of you, what's your biggest risk on your mind for the back half of this year?
Inflation gets a little bit out of hand and forces the Fed's hand, and they actually do have to hike, and Powell ends up kind of looking like an idiot for talking
The
down.
risk for what? For equities?
Yeah.
Yeah,
If they hike, they'll spook things.
Yeah,
Well,
I think the
we'll
biggest
find out more
risk
tomorrow.
for equities is that prices go down.
JC, what's your biggest thing on your mind?
Just in generally speaking,
Just general. What are you worried about?
well, I don't really worry about anything. We just take the. I used to worry about things. I don't worry about it at all because I don't really give a shit. We just take the data as it is. What I find most interesting, I think, is the rotation. Getting back to what we were talking about before. The things that were working last year have turned into the worst things. A lot of the things that were not working last year are some of the best things. You've got mean reversions from both extremes. The best things mean reverting lower. The worst things mean reverting higher. China, for example, these short squeezes are just one of the things that were terrible that are now mean reverting higher. And that's what creates, a frustrating market for trend followers, for example. So I think it gets back to recognizing what type of market environment we're in. and looking around at some of the characteristics and some of the things taking place. And, to Strazza's point, he continues to pound the table. There continues to be things working. My argument is that there are more and more new things working, right? But there continues to be things working. I mean, you're seeing in the advanced decline line. I think the advanced decline line speaks to that. There continues to be things that are working.
I don't like the way you've been talking about tech stocks.
Why? Like mathematically, how would you prefer me to talk about tech stocks? Not using math, like ignoring math?
Strong language. It's not that they haven't been working. Just like last summer.
Why don't you throw up slide 2 so we can talk about just how bad technology has been? Go to slide 2. So over the last 10 weeks, there has been no worse place on the planet than technology and consumer discretionary. In other words, no group of stocks have lost investors more money on this planet of Earth than technology and consumer discretionary. Whether you look at large caps, whether you look at small caps, whether you look at them on an equally weighted basis, whether you're looking at ARK, you cannot find a worse place for investors to have been over the last 10 weeks. So Strazza doesn't like it the way I'm talking about it, but all I'm doing is just counting. How would you prefer me to talk about them?
Let me give you like a real example. So in this first or second week of March, which is almost exactly 10 weeks ago, we got long Google on a pullback at about 130. It's at 170 today. Google's a tech stock, in my opinion. So we've been getting long tech stocks and making money consistently over the last 10 weeks.
Right?
The index, XLK, you don't like the way that looks. Apple's been weak. I get that.
It's not about what I like or don't like or what anything looks like. It's just math. And I literally just said that there are opportunities to make money. And I like Google. I'm with you. But that doesn't change the fact that there is no sector on this planet that has lost investors more money over the last 10 weeks than technology. You might not like it. Maybe I don't like it. It doesn't matter. That's just what it is.
But how much have they really lost?
Or the long duration trade that everyone was getting on that hurt too.
There's been no worse group of stocks. It doesn't mean that some of the stocks haven't worked. We keep saying that they have, and they will continue to, in my opinion.
XLK is 2% from all-time highs, sir. I just feel like this is some strong language. No?
They are the worst group of stocks on the planet over the last 10 weeks.
You guys are going in circles.
Strong language, maybe, but just facts only.
I don't know, man.
Blake, can I get a witness? Facts only.
I don't know. All right, Blake.
Last question. Hold on. How's Jen? How are the kids? When are you coming back to Key West?
We usually do our annual trip in December, so we haven't even thought that far. Kids are great.
It's
lax
season, right? Blake is lax season.
Last night, I literally go. I have 4 kids now playing lacrosse, and where I live in Maryland, it's like religion, which always makes. I never quite got the Bradley Cooper line in that movie, Crab Cakes and Football. I mean, this state is nothing but lacrosse. It's crazy. That's all parents talk about. Tryouts are in like 2 months. That's all people can talk about. But no, I mean, I just go from field to field. I have no spare time.
Did you play? Were you a lacrosse player?
No, my wife was recruited. She played D1 at Maryland, but I was a hockey player.
Oh, wow.
So she's the coach, not you.
Well, no, I mean, I'm the one who's always out in the yard with the boys. So I actually have gotten myself not so bad at lacrosse at the age of 39. I'm a decent, washed up dad lacrosse player.
Nice.
Love that.
But well, I just got the reminder on my calendar. We're traveling out to Future Proof 4 months or 3 months, 4 months from today. September 9 minus 5 is 4.
Me and Strazza are doing the rap. We're the music guests.
Yep.
So last year it was Redman and Method Man. This year is JC and Strazza.
Lord help us.
Yeah.
You guys all going back?
Pitbull was the technical analyst. That'd be me.
MC Strazza.
You guys all going back?
Yeah, we'll be there.
Nice.
We'll be there.
All right,
and then we're
fellas,
going straight to Chicago from there.
Guys, check out Blake's Substack. I dropped the link in chat. Does great work there every day. Blake, thanks a lot, man.
You're the man,
guys.
Thanks, Blake.
Later.
See ya.
Wow.
I'm getting hated on. JC's so full of shit. A fly just flew out of his mouth. It's just
it's not that you're
it's
full of
just
shit.
math.
It's the language that you're using. It's just very.
That was good.
I had to look at my chart and I was surprised XLK wasn't in the 10%.
That was funny.
The way you're.
That was funny. It is funny, but I don't understand how I'm full of. It's literally just math. Like it's not like my opinion. I wish it wasn't this way. In fact, if it wasn't this way and it was the opposite and these things were working, I would have more money. So, you know what I'm saying? Like, I'm not like, I wish it wasn't this way. It just is.
All right. If you're keeping score at home, we're at 3 trading halts so far for GameStop and 3 for AMC. So keep
All
it
right.
coming, guys.
So not many.
It's come off a lot.
It's 9:47. Yeah, that's a lot.
Damn.
These are 5-minute halts, man.
But they're all going. BlackBerry, AMC, holy.
They're well off the highs.
Mathematically, it's quite a lot.
I got a
Anyway.
list here. I could tell you what's really moving. I got my fresh squeeze list right in front of me.
We'll save the good stuff for later. As a reminder, 4 o'clock Eastern time today. We don't often, well, it's not every day we do a stream at the close. We're doing one right now. 4 o'clock today.
How can we not? Right, Strazza? How can we not do this today at 4 o'clock?
No, it would be silly because sometimes it's we like to give the people what they need, but sometimes it's when they're all thinking about a certain theme or a certain topic that you want to bring it to them because they will listen. This is a perfect time.
I text message yesterday, Strazza, you and me tomorrow 4 o'clock. He's like, in how long? As long as you want. I got nowhere to go.
Yeah, no, I'm excited for it. This is a fun list. Also, just it stands out right now, Spencer. These charging companies are ripping today too. Isn't Plug Power and CHPT? Don't they do like Tesla charging things?
Dude, EV. There are many EV related companies that belong in this meme group. So Plug is one of them. Oh gosh, I remember Plug. Plug Power has been around for like 20 years.
Getting some action here today.
More than that. 22 years this stock's been around for. Yeah, that's up 50%. Good day for Plug Power. Well, what else did I have here? Let's see. Let's go through the movers, see what jumps out in meme land.
Throw up slide.
Man.
Throw up slide.
Trupanion, TRUP, that's the pet food. Having a day. Wouldn't be a meme stock.
No,
Really without
TRUP
Hertz.
is pet insurance.
Sorry, pet insurance. That's what I meant. Hertz up 5%.
Everything on the freshly squeezed list except for like 3 issues are green today. I have over 200 stocks on here. I've never seen anything like that.
Well, there's a couple of things that we're going to talk about later today, so I don't want to reveal everything. But just keep in mind that when things like this happen, the margin clerks have the ability to raise margin requirements at any time that they want. It's a dictatorship over there.
Yeah.
So there's an element of that where they go, okay, we're going to raise the margin requirements on all these things, right? So there's a lot of shenanigans going on behind the scenes that they don't teach you in the CFA exams.
Yeah.
Right. That you have to understand the way the mechanics of the market work, which is why understanding the behavior of the market itself and market participants is so much more important than whatever goods and services the market claims to be dealing with, right? So, and we say that because these Chinese stocks, who knows what the hell they're doing.
So JC's point is, if you don't have much available margin in your account and you're short one of these stocks coming in, all of a sudden they could say you have to post more. You get to your desk this morning, the same position you had yesterday, you need to post more collateral. You don't have that cash in your account. What do? You buy back shares. What does that do? It pops the stock. Right. So you're seeing that across the board. It's like a systemic squeeze, right? Where the brokers will raise these margins because they see GME's going, AMC's going, let's prepare ourselves. And then it creates a little across the board.
You know what else?
Heavily sorted names.
You know what else? I wondered the last time we had a meme stock craze, there was no such thing as zero DTE options. So I do wonder,
dude, these charts, it's too much with the zero DTE.
No. I'm just asking from a like gamma squeeze perspective. Like there could be something else there that will add more.
For the record, most of these things don't have zero DTE.
Oh, really? Well, like GameStop, no
idea.
I don't know. I don't know either.
What kind of sick Who needs 0 DTE options on a stock that can move 100%?
All right, maybe they don't have it. My
What?
mistake.
No, they don't have it.
What is
Okay, my bad.
what is
Never
going
mind.
on in your life if you're trading 0 DTE GameStop?
Sorry.
Well, let's remember that the 0 DTE options is actually very, very useful and one of the most valuable developments in the history of financial markets. Let's keep that in mind.
Really? You think so?
I know for a fact, right? What is it? 75, 80% of 0 DTE options are by institutions that are hedging their portfolios throughout the day, right? The fact that junkie traders are using it too, that's their problem. That they're not relevant. This has been one of the most important developments in the history of financial markets. There's no question. It really helps institutions hedge their positions on an intraday basis, where it was a lot more difficult to do before.
I wouldn't know.
There's a reason why they run all that liquidity. They own it all.
I literally wouldn't know because this is so new. Last time I was at an institution and had any kind of insight into what they were doing, this simply wasn't around.
I guarantee you that those institutions that you're talking about are using them all day, every day.
Yeah, I'm sure. Yeah.
Guaranteed.
Making markets in them too.
Yep.
All right, a couple headlines I want to read off quickly. I think we have a chart of Kraft Heinz report from the WSJ yesterday. Kraft Heinz is shopping Oscar Mayer.
Oh, speaking of CME. Oh, sorry. Yeah, and then I got something on CME.
Yeah, okay.
Mayer,
Well,
you into it?
Kraft Heinz is trying to find a buyer for Oscar Mayer, saying it could fetch anywhere between $3 to $5 billion. I think we have a chart of Kraft Heinz laying around here somewhere. Thought that was interesting.
Horse head only at my house. Won't find me eating that fake ham.
Oscar Mayer actually surprisingly good bacon. Surprisingly good bacon.
You're right. Yeah.
I didn't realize that until recently, but their bacon is not terrible. I wouldn't
Bacon
buy
makes
anything else.
everything better.
Yeah, this is true. Also, we talked the other week about that BHP Anglo American mining takeover deal. Anglo American rejected BHP's offer, but as part of that, they said they're gonna spin off a couple parts of their business to unlock shareholder value. So they're gonna try to spin off the De Beers, the diamond business, and their platinum business as well. So
did you see what was it, the CME or the SIBO in the news, or was it CFTC? CFTC chair. He was making the rounds yesterday. They proposed a new rule on derivatives betting on elections. They're
yes. I saw that over the weekend. Yep.
It's trying really hard to have nothing to do with the shit show that's going to happen in November of this year.
Yep.
Because what happens is if they allow people to trade instruments that are tied to an election outcome, then they become somehow based on like the Constitution, some sort of like authority on the outcome of the election. So that they're basically coming out like, yo, this has got nothing to do with us. You can't trade this stuff. Go do it on DraftKings or somewhere else. So I thought that was pretty interesting. I don't blame them one bit.
That's what we need. So yeah, anyway, and then as far as headlines go, just keep an eye on a lot of at the market offerings, debt to equity exchanges. Basically, all these companies are going to be using this opportunity to sell some stock today, tomorrow, this week.
They better.
They will. They will.
AMC already did, but that's the only one that announced it.
Tilray also. So that's what I got.
All right. Yeah.
Tilray also. Tilray up 10% on that news of more supply for its stock. Of course.
All right.
Is that funny?
Yeah, it's hilarious. No Patrick today, unfortunately. But do we have a hot corner?
Yes, we do.
Nothing good today.
We do.
Nothing?
Nothing? Oh.
That's not true, Strazza.
Bummer.
Strazza, I think you're just being a negative Nance. Nance. What about the 5.2 million on CMPO? It's a lot of money. No?
I mean, look at the chart. What do you want me to say about it?
I mean, it's a $500 million stock, metal fabrication. Why don't you hit the ball? All right, never mind. CMPO, no?
I don't know. I none of the charts really stood out to me.
Right, but that's a significant investment in the metal fabrication business which is consistent with a lot of other things we're seeing. Is this a SPAC? I think that's a SPAC.
Leak rotor. Here's what, if this was a person, I would say, ooh, 5 million.
Yeah.
When I see an institution file a Form 4 for 5 million, I don't overthink it. If it was a 13D and they said they own 5%, I'd say, okay. Just the Form 4. It does mean, though, that they probably have a 10% stake if they're filing a Form 4.
If they're filing a Form 4, right. Yeah, all right. Strazza's right. There's not much exciting going on here. Yeah, all right, Strazza, I'll give you that one. You're good.
The grocery outlet, GO, is the one chart that kind of caught my eyes because when I see stocks scrounging around near range lows, I think to myself, ooh, mean reversion.
And who bought it?
Hmm?
GO, Eric D. Raggets, $2 million. All right, Eric D.
Yeah. Some of these squeezy names coming off the lower bounds of ranges, I'm not uninterested in. I'm paying attention.
This guy's like the chairman of a million companies. This guy is such a tradfi, bro. Look at this guy.
Part of the show where JC is going to tell us how wealthy this man is and whether or not.
No, he's just like when you think tradfi, bro, that's what this guy looks like. And I say that respectfully, Mr. Eric D. Raggets. Bottom fishing in this grocery store, 2 million bottom fishing this grocery store. Look at this guy. I mean, when you talk about tradfi, bro, like this guy, come on.
He's wearing a vest. All right. I'm excited for the price.
He's thinking about wearing a vest.
All right, let's do some recess.
All right, let's go.
Do it. So we were walking in the park the other day, and one of the kids was talking about the Great Bambino. And my daughter's like, Daddy, who's the Great Bambino? So she's 3, in all fairness. So I was like, all right, sweetheart, it's time. It's time. So we went home and we put on The Sandlot.
Nice.
And we watched The Sandlot 3 times. 3 times. And, my daughter now knows who the Great Bambino is. She watched The Sandlot. It really did bring a tear to my eye watching The Sandlot for the first time with my daughter. It was a special moment. Special
That's
moment.
an all-timer.
Shout out Sandlot.
Did the boys watch it too or too young?
Yeah.
No, they were watching. They just don't really know. Like, they're 1. So, like, it's just colors and noise,
That's wonderful. Just want to give an update. We have arrived at season 4 of The Wire in this household. So we have arrived at my favorite season of the show.
Yeah.
We're there. We're in it. It's taken us 2 months, but we're trucking. We go about 1 a day usually. So we're getting there. We're on season 4.
Why can't I remember his name? What was the guy's name who ran the port with the sun? Frank
Sabatka.
Frank Sabatka.
Sabatka. Yeah.
That's so good, man.
I'm still out here, just chugging along. So it's Tuesday. We have Twitter Spaces in an hour. Chart Request Live with Strazza and Pat at 1:00, as we do every Tuesday, Thursday, and last but not least, 4:00 Eastern time today, right when the market closes. Our freshly squeezed live event, special short squeeze, talking meme stocks, talking squeezes, how to find them, how to act, all that good stuff. 4:00 Eastern time. Be there.
And then we got Knicks Pacers after that. So you can follow that up with some Knicks Pacers.
Knicks Pacers tonight. I assume 8 p.m. I don't actually know.
Yeah, it's 8.
Hopefully it's not as bad as the other night, but that's what I got. Thanks to Blake. Thanks to all of you in the chat for hanging out. JC, Steve, Afonso, go make some money. Put you guys on the flip side.
Forever.
I can't take no loss.